You may need to submit a self-assessment tax return if you have self-employed earnings, income from property, or untaxed income such as tips or commission. It is better to finish your return early to avoid the last-minute rush at the end of January. The thought of sorting through your old receipts and working through confusing tax can be completely putting you off, but we're here to help. For most employees, tax is automatically deducted through your PAYE, but when you are self-employed, it's up to you to notify HMRC. Through your self-assessment tax return, you'll let HMRC know what you have earned in the year and the tax that you will owe. You will need to submit a self-assessment if you've had income from self-employment that's more than £1,000, more than £2,500 income from rental property, more than £2,500 on other untaxed income such as tips or commission, more than £2,500 on other untaxed income such as tips or commission, income from savings or investments of £10,000 or more, profits liable to capital gains tax. You'll also need to complete a return if you are a company director, if you claimed child benefits and you or your partner's income was more than £50,000. Step 1 is to register with HMRC. When you have registered, you'll receive a unique taxpayer reference number which you will use to sign into HMRC for their online services. HMRC will then send you a PIN shortly after in the post, which you can use to access the online services and file your return. Each personal tax return year ends on the 5th of April. The deadline for the paper return each year is the 31st of October following the year end, and online returns must be filed by the 31st of January, i.e. nearly 10 months after the year end. If you are registering as self-employed, you'll need the following records: all of your business expenses, records of any sales or income, PAYE records if applicable, VAT records if applicable, records of your personal income. If you're employed or a company director for a limited company, then you may also need a P45, a P60 and a P11D forms, certificates from a tax award scheme, information about any redundancy or termination payments, information about income and benefits of your job. This will include your first payment on account towards the following year if applicable, and any tax that you might owe from the previous tax year. The deadline for the payment is the same deadline for submitting the return by midnight on the 31st of January. You'll be fined if you submit late, even if you're only 1 minute after the deadline at midnight on the 31st of January. The initial penalty is £100 if you're up to 3 months late, but this will then increase the longer that you leave it. After 3 months, i.e. from the 1st of May, you will receive additional penalties from £10 per day with the maximum of £900. After 6 months, a further penalty of 5% of the tax due or £300 charge, whichever is higher. After 12 months, another 5% or £300 charge, again depending on which is higher. If you pay your tax bill late, then you could face additional penalties of 5% of the unpaid tax at 30 days, 6 months and 12 months. However, if you filed your tax return late but you do have good reason, then you're able to appeal the penalty. The circumstances can include if a partner or close relative passes away prior to the deadline, a serious illness, emergency hospital stays, unexpected delay in the post, an IT hardware or software failure, external causes such as a fire, flood or theft preventing you from completing your return, issues with HMRC. It has to be a genuine, serious reason. You can't just claim that the dog has ate it. Here are some of the common mistakes that people make when filing their return and ways to avoid them. 1. Missing out on tax relief. Remember to make sure that you are claiming back tax relief where you're eligible for it. This includes things like charitable donations that you've made, pension contributions and/or work expenses. 2. Not declaring all your income. All of your taxable income needs to be declared on your self-assessment, including your earnings, dividends, pension payments, interest on your bank account, capital gains, rent from a buy-to-let property. 3. Late or incorrect filings. Rushing through your numbers last minute increases the chances of you either overlooking something or putting something in wrong. If you have realised that you have made a mistake, then you can always amend your tax return within the first year of the 31st of January deadline. There is still a chance though that you could face penalties if HMRC decide that you did not take reasonable care in providing the right information. Alternatively, to avoid any other issues from the very start, speak to an accountant to ensure that it is all completed accurately and on time. I hope you found this useful. If you would like to know any more, please get in touch using the details below.